What is free cash flow? Free cash flow, often shortened to FCF, is the money a company has left over after it has paid all its operating expenses and the costs of maintaining or expanding its assets, such as buying equipment or upgrading buildings. Put simply, it is the cash a business generates that is truly free to use for other purposes, such as paying dividends, buying back shares, reducing debt, or investing in new opportunities. The basic formula is free cash flow equals operating cash flow minus capital expenditures. This makes it slightly different from operating cash flow, which only measures cash from everyday business activities without subtracting those investment costs. Why does it matter? Free cash flow matters because it shows how much real cash a business is producing, not just what the profit figures say on paper. A company might look profitable on its income statement, but still struggle if very little cash is left after expenses. For investors, FCF gives a clearer picture of financial health. It is also useful for management because it tells them how much spare cash is available to fund growth, reduce debts, or simply keep the company steady through uncertain times. A business with strong free cash flow is often more resilient and flexible, able to reward shareholders while also investing in its future. Emotionally, this can give investors peace of mind knowing the company has money on hand rather than simply relying on accounting numbers. Here's a simple example. Imagine a company earns £500,000 in cash from its day-to-day operations in a year. To keep the business running, it spends £200,000 on new machinery and building maintenance. Subtracting this from the operating cash flow leaves £300,000 in free cash flow. This £300,000 is the spare cash the company can choose how to use, whether that's giving some back to shareholders in dividends, reducing its debts, or setting it aside for new projects. If another company earns the same profit on paper but has almost no free cash flow, it may not actually have the flexibility to do any of these things. What else should you know? Free cash flow can be more reliable than profit because it looks at actual cash rather than accounting adjustments. But it isn't perfect. One limitation is that FCF can swing sharply from year to year, depending on big capital investments. A company that spends heavily one year on new factories might show very low free cash flow, but that doesn't necessarily mean it is weak. It may simply be reinvesting for growth. In fact, negative free cash flow is not always a bad sign if it is caused by smart long-term investments. Another important point is how FCF is used. Analysts often rely on it for valuation methods such as discounted cash flow, which aim to estimate the true worth of a company by projecting its future cash generation. For this reason, it is one of the most closely watched financial measures. However, even though cash flow is harder to manipulate than profit, it can still be influenced. A company might delay spending on projects or sell assets to make its free cash flow look healthier in the short term, so investors should always consider the bigger picture. It is also worth noting that free cash flow can look very different across industries. Software businesses often need less capital investment, so they tend to have high free cash flow. On the other hand, manufacturing or energy companies may report lower figures because they must constantly spend on equipment and infrastructure. Comparing companies within the same sector, rather than across very different industries, usually gives a clearer picture. To sum it all up, free cash flow is the spare cash a business has after covering its essential running costs and investments. It is a practical measure of a company's financial strength and flexibility, often more revealing than profit alone. While it can vary sharply year by year and differs between industries, strong and steady free cash flow is usually a good sign that a company can both reward shareholders and invest in its own future. Negative figures are not always a red flag, especially if they come from reinvestment, but sustained weakness can raise concerns. Used wisely, free cash flow helps both managers and investors understand how much money a company really has to work with. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.